Rate hikes could spell economic doom. Let's have a look. Hello everyone, Florian Heiser here, and welcome to another episode of Heiser Says. Grab your stein of coffee, because I want to have a look at this article from news.com.au written by Tarek Brooker about, well, rate hikes and what that could mean for our economy here in Australia. We were looking at APRA reaching out to ADIs about their capacity for negative interest rates because, while it's highly unlikely, they're still concerned it might happen. And this is the other end, where our interest rates, which is at 0.1%, the cash rate, could be forced to go up, maybe earlier than the RBA hopes. Let's have a look at that. But before, I just want to draw attention to the sponsor for this video, which is our US channel, Heiser Says US. Same style, same topic, focusing on US news and issues. Check it out, please. So, let's have a look at this article written by Tarek, seeing what he has to talk about. So, sign Aussie interest rates hike could happen sooner. Our economy hinges on interest rates not rising for 18 months. But there's increasing worry. No one has a clue what will actually happen. Well, yeah, I think I'd have to agree with him there. If we have a look at some previous predictions from our very own Reserve Bank about the wage growth. Now, they kind of missed it in 2011, 2012, 2013, 14, 15, 16, and 17, but I'm sure they'll get it right this time. Of course, they have to. Let's have a look. So, as the RBA continues to insist that rate hikes are not coming for at least 3 years, the reality is arguably quite different. Now, here's the thing. If we had rate hikes, how many people are going to cop it? Now, if we have a look, I'm going to bring up a few charts just to show you here. This is looking at the number of loans and negative equity that's going down. Because when we talk about rate hikes, we're all worried about property. Here we have a look at housing loan prepayments. People have paid ahead. And you've got liquidity buffers in your houses. Even indebted homeowners are 4 months ahead, and renters are several months ahead. So if we have a rate rise, will that time period be enough for the people at risk to spur their politicians to start political will to intervene in the market? Is that when we might see Mortgage Keeper manifest? I'm becoming too cynical now with regards to our politicians. We can't possibly have a free market here. We can't leave it to its own devices. No. They'll intervene. Anyway, in the words of New Daily Economist and economic commentator Alan Kohler, the RBA has absolutely no idea what's going to happen. Nobody does. We are in entirely uncharted waters, but a highly distorted financial system and economy, all supported by $4 billion a week in RBA bond purchases and a predicted federal deficit of almost $2 billion per week. It's possible we could see inflation rocket higher than the RBA's forecasts, forcing rate hikes earlier than anticipated due to supply chain-driven inflation and a much tighter labour market than expected. However, it's also possible that the global economy could struggle badly as the Chinese economy slows and the last of government stimulus feeds through the system towards the end of the year. That may even see the RBA cut the cash rate to 0% or perhaps even to negative interest rates. The truth is we don't know, and it may pay to expect the unexpected. He's got a good point there. You've got to prepare. Who knows what's going to happen? This is the thing, particularly with consuming news and media. If you just go down one tangent or one path, you form into like a constant self-affirming spiral of information, an echo chamber. If you're just going, the sky is falling, you want to get a variety of sources. So, what does transitory inflation actually mean? We're going back to this old chestnut. From Australia's own Martin Place to halls of the United States Congress, there is one word central bankers are overwhelmingly using to describe the ongoing rise in inflation: transitory. The almost universal consensus among central bankers of the Western world is the current inflationary pressures are transitory, temporary, and will pass. Therefore, justify not rising interest rates for years to come. Broadly speaking, economists generally agree. It will be at least 18 months before we begin to see rate hikes. But there is a larger elephant in the room. Does it mean 6 more months of rapidly rising prices well above central bank inflation targets, 9 months, or even longer than that? Well, we're starting to see the lumber in the US is starting to cool down, everyone. You know, it's down from its peak. So perhaps, and well, shipping costs, actually, I'll bring that up. I was looking at this today, and we'll have a look at the Freightos index because, well, it's every time I look at it, every time we look at it, it's higher. We'll jump to it here. So there you go. 6,495. This is the global container index. You can see, look at that. This is what it used to be last year. $1,000 with change. You know, maybe 1,500 in 2020. Look at it now. 6,000. Okay. You've got China to East Asia. Oh, okay. I got to log in to get my access to it. There you go. What are we up there now? See, okay, we've cooled down a little bit there. Where's this one? Here we go. China, East Asia to North America. So going from China to North America, this way, the East Coast. $10,000. $10,000. So, well, here we go. Through the Suez Canal to China, East Asia to Northern Europe. $12,377. From where it was last year, $1,600, guys, $1,700. Look at that. Look at that. Okay, so this is insane, these cost increases. So if this cools off, if we start to see this taper, then one could argue it's transitory. Hopefully. Because look at these increases, guys. You're going to start seeing this manifest more and more with imported products, particularly in a country like Australia. Anyway, back to this. So far, it's a question that central banks have generally remained tight-lipped on, allowing themselves quite a lot of scope to shift their commentary due to the ambiguity of how they define the word transitory. But central banks aren't the only players in setting interest rates for credit markets and mortgage borrowers. If down the road global bond markets run out of patience with promises that inflation is temporary, they could then force up borrowing costs for banks and mortgage holders all on their own. And there are a number of forces that might keep higher inflation around for longer than central banks expect. Supply chain issues for longer. Well, there you go. In decades gone by, companies once had vast warehouses filled with stock to ensure that their commitments to retailers or suppliers could be met. But in an age of global trade, defined by just-in-time business model, all of a sudden many companies have found themselves without the raw materials and finished products required to meet demand. After tens of trillions of dollars were pumped into the global economy over the past year, it is perhaps unsurprising that manufacturers, logistic companies, and the maritime freight industry are buckling under the strain. I mean, we can see just we've looked in other articles, just some of the prices that these maritime companies, the ones that just hold the ships and lease them out, how much they've been getting just for these cargo ships. No wonder, based on how expensive cargo is at the moment to move around. The current global manufacturing and logistics network is simply unable to cope with the current demand, and there are no quick or easy fixes. We just need to get the new Zeppelin, new tech back. I've been playing too many steampunk games recently. In the Pearl River Delta anchorage located south of Hong Kong and the Chinese megacity of Shenzhen, there are currently more container ships waiting to dock than during the height of the impact of the pandemic on China back in February last year. There you go. As a result of the factors and an outbreak of the Delta coronavirus variant in southern China, the cost of shipping has skyrocketed to all-time record highs. For example, in mid-2020, it cost under $2,600 to ship a 40-foot container from Shanghai to Rotterdam. Today, it's $16,300. It's a similar story for shipping from China to Western United States, with a 40-foot container from Shanghai to Los Angeles going from $2,600 to $15,800. The Freightos stuff I'm looking at is the 20-foot containers. According to reports, some companies are being charged as much as $26,800 for container loads booked from China to the Western United States at the last minute. So immigration, inflation, and rate hikes. When Treasurer Josh Frydenberg handed down the federal budget back in May, it included a forecast that unemployment would remain at 5% at the end of the 2021, the 21-22 financial year. However, when the ABS released the May unemployment figures a few weeks ago, Australians were given a pleasant shock. The nation's unemployment rate came down by 0.4% in just the single month to sit at 5.1%, almost achieving Treasury's forecast before the 21-22 financial year had even begun. While there are a number of different factors that have contributed to the labour market recovery, such as government stimulus and, ironically, closed borders, there is one major factor that could push the nation's unemployment rate head towards historic lows: low immigration. With the international borders now closed for more than 15 months, Australia's pool of available labour has shrunk significantly. Between Australians and temporary visa holders leaving the country permanently and reversing net international migration, there are more than 1 million fewer people in Australia than there have been without the pandemic. Even after removing those who are not of working age, not allowed to work, or not in the labour force, the reduction in the size of the nation's labour pool remains a definite driver behind the strong labour market recovery. If the unemployment rate continues on this trend towards a rapid decline, we may see upward pressure build on wages before international borders reopen sometime in mid-2022. With the RBA forecasting relatively weak wage growth for at least the next few years, the shock of wage growth above the estimates could place upwards pressure on interest rates. So, what are we going to see there? We're going to see them open up the borders any chance they get. They're going to do whatever they can for tourism, for international education, and demand for labour, everyone. I bet you. I suspect that's what we're going to see. So what are the solutions and the takeaways here if you're worried about a rate hike and the economic damage that can do? Perhaps plunging us into another recession. Will the government then, intervene once again? The problem is now, the precedent's been set. There's going to be calls for massive stimulus for the lifespan of this generation. Every single time. Are we ever going to have another recession? And it may sound cruel, but we need to have companies that deserve to fail, because that creates space and opportunities for innovation. So if we don't allow that to happen, if the government just keeps coming to the rescue again and again and again, is Australia going to end up like Japan? Anyway, what would I encourage? I'd encourage an increasing understanding of financial literacy for everyone. You want to get people free of debt and create a diversity of income streams, particularly if we're going into another recession. What's your take on this one? And do you think they'll open up the borders? And what will they do to keep the can going down the road? Or will we get good old mortgage keeper, guys? Let me know your opinions on this article by Tarek. As always, guys, thanks for watching. Like, share, subscribe to the channel. If you're a fan, you know how to support us. Take care, guys. I'll see you next time. Bye for now.